George Hallmey, and this morning we're going to be talking about reversal patterns and the Gartley, and we're going to add to that its very close cousin, the bat pattern. Fine, excellent. Glad you can all hear me, and of course the important thing, you can see my presentation. Right, okay, let's get started. This presentation is actually going to bring in quite a number of features. When we're analyzing, then we tend to sort of bring together quite a number of features that we as traders keep tucked away in our sort of trading toolkit. And the multi-point reversal is the main, indeed, is the main pattern that I use to pick out reversals. And the straightforward multi-point reversal is rather like a standard 1, 2, 3 pattern, but it quite often will have many more than just 3 points to it. It can be sort of 5 or indeed 7. Victor Sperendio came up with the 1, 2, 3 and presented it in his book. Highly recommend the book, Methods for Wall Street Master. There are all sorts of little variants on it. The Ross hook, albeit the Ross hook gives a very, very late entry, and so late that very often the best of the move is actually done. But the Gartley is a variation on the multi-point reversal, and it brings in the most important parts of the MPR, multi-point reversal, with Fibonacci and Elliott waves. And the one thing I've missed out there is candle analysis as well, because I use candles as the sort of final trigger, if you like, to place the trade. So let's just look at the standard multi-point reversal pattern. It starts off, it needs, this is a bullish one, it needs a decline prior to the pattern developing. We never quite know where point 1 is going to actually occur. So it's really just a question of watching the pivots. And a pivot is just where price sort of reaches a low and then pops back up. And eventually we get this lowest low, followed by a pretty strong, usually it's a pretty strong attempt to rally up. As I find it the other way around, to be quite honest. I find the Ross hook, I use the Ross hook for actually slightly longer term. However, after we can see the rally back up against the previous dominant trend, then a higher low is formed. Now, it doesn't have to be spot on a higher low. It could be exactly the same level as the previous one, popping down to a double bottom, or indeed there might even be a tail of the candle that pops down below point 1. But ideally, and this is an ideal version, it will end with this third very, very clear point. It's a higher low, and as mentioned just now, it's got this perfect candle pattern. And that candle, which I'm sure you will recognize straight away, you've got a hammer candle there with a long tail. Those long tails, I just love those long tails. And then away it goes. Now, I've not actually drawn all the numbers in here, but after number 3, then price rallies up even further, takes out the preceding high, and it then forms point 4. Then it comes down to point 5, point 6, point 7. So this is a multi-point reversal with 7 points, and the entry point for me is immediately after the odd number. So it's going to come there at point 3, or point 5, or indeed point 7. Happens in reverse, of course, multi-point reversal, where we get a high after it needs to have been moving up. Ideally, this has been a strong move up, then we get a real strong correction against the main trend there. Comes down to point 2, pops back up, point 3. Very often that's at a fib line. It may well be some of the standard fibs, 38.2. 61.8, or indeed, I like the really deep ones that go through to 78.6 and 88.7. But this particular one, then completely, you can see the candle here, the big red candle, it actually completely engulfed that preceding green. So there we are. That was the pattern completed, and away we go. Now you can do other things. You can draw trend lines up through here as Victor Sprendio does. You can wait for the trend line to be broken. You can wait for point 2 to be broken before entering the trade, etc. But I like to get in as early as possible for 2 reasons. My risk is going to be minimal if I get in early. I can have a real tight stop loss. And also, it's going to increase quite dramatically my potential profit. Anyway, let's just consider some of these other fibs. I've mentioned 78.6 and 88.7. So here we are. We've got a down move, got a sharp downtrend, and then we've got a rally back up. And whilst 38.2, if we've got a runaway trend, ideally where it's moved on somewhat in the wave count, but certainly on once we get the first big move down, usually the first rally back, I say usually, quite commonly, the first rally back is going to be a real deep one. And it goes way beyond the standard ratios of 38.2, 50, and 61.8. And then I find that 78.6 is one of the most reliable fib numbers. So if I see price sort of moving back into that region, then I'm sort of starting to feel that there's a fair possibility that there could be a reversal. And I'm then going to look for some candle evidence to tell me that that reversal has actually come through. Right, now let's just look at this little series of lines that we've got. So, as mentioned earlier, a standard 3-point multi-point can turn into a 5-point. Now, this is a 5-point, and you can see here slight variation on the earlier slide we looked at, where point 5 is actually below point 3. But the whole point of this pattern is that it does not want to go below point 1. Okay. Now, I mentioned here that the move from 2 to 3, 3 to 4, and 4 to 5 is a very important part of Elliott wave, and in fact is probably, certainly for those people first looking at Elliott wave, it's one of the most tradable patterns. It's the ABC measured move, where the distance traveled, or at least the vertical distance traveled from 2 to 3, is very often exactly the same as the vertical distance traveled from 4 to 5. So ideally, the trader is going to see this move down from 2 to 3 and then the rally up to 4. And provided that that trader can spot the reversal on down to continue the trend, can be reasonably well assured that the distance traveled from 4 to 5 is going to be much the same as 2 to 3. Now, sometimes it's going to be a Fibonacci multiple of it, but look for those measured moves, those ABC patterns, and they just crop up time and time and time and time again. So this, in actual fact, is then combining a multi-point reversal with a Gartley. And there are 1 or 2 features of the Gartley which are all important. The first one being that point 3 needs to come down to retrace of the distance from 1 to 2 around about 50%. Now, it might be 61.8. It might even go a little bit beyond 61.8, but it's going to be in that sort of region. And then point 5 needs to come down to that magic fib number of 78.6. So, well, I've just jumped a little bit ahead of what the slides are actually telling me here, but it's well worth just repeating and having a closer look at this measured move approach. The measured move then is going to give us an entry, and the entry is at 4. It's at 4. So one could go short here whilst this overall pattern actually develops. Okay, one could go short once you've got the evidence that this has turned the corner. And 4 again, I mean, if we'd have put the fib grid on between the peak at 2, okay, and the trough at 3, we may well find that it turns the corner at a nice, neat little fib number, little bit of candle analysis, and then on down it goes. And of course, you know, if we're going to be in this trade and we're going to be following it on down, we find that price is now getting down towards the area of reversal, which is sort of 70.7, 78.6 of the distance between point 1 and point 2, then we're going to be looking for evidence that it's going to turn the corner there. So we're going to close the position, hopefully take some profit on that move from 4 to 5. Right, now let's just have a look at the standard Gartley. Let's say we've got a little bit of sideways price action going on here, and then price moves on up. And we'll just use the standard sort of notation here, which starts with an X. All right. Price then moves up smartly to A. It then retraces, and it retraces down to somewhere around about 61.8. Doesn't have to be spot on, but in that region of 61.8 is the ideal Gartley pattern retracement here. Price then pops back up. Up it goes, rallies back up, fails, and the rally fails somewhere between 38.2 and 88.6. So quite where that one fails is not prescribed closely, but the fact is it needs to fail at some point before getting above point A. Okay. Then on down it comes. The C to D move then is going to be that measured move or something rather like it. So it may be a Fibonacci multiple of the A to B distance. So C to D, you know, it might just be 50%, might just be 61.8. It might even go to 138.2. That, of course, will depend somewhat on how far this thing rallied back, B to C. Okay, now point D is the all-important part of this, and it is going to be 78.6, okay, of the distance between where it started from, which is X, and then where the rally up went at A, all right? So 78.6 is where it comes down to. Of A to B, then, as I've mentioned, this can be a multiple. This can be a move down, and it's going to be a multiple of the A to B, and it's going to be a Fibonacci multiple of that. So here we are. This is a bullish Gartley. Where are the targets? Well, the first target is a move all the way back up to A. All right? That's going to be the first target in that region. And typically, that's exactly where price is going to pause. It's going to pause in the region of a previous high. But then after that, measuring the move down from A to D, targets then will be multiples thereof of that A to D move. And we then measure up using a fib grid, which will then take it to 127, 161.8, and that is a typical target where price then moves on. Now, indeed, you can actually look at this overall and see there that that's yet another measured move in the making, because if you reckon on X to A being a fairly strong move, A to D being the correction, and then D to the final target, could well be a measured move of the entire pattern. Now, these Gartleys so often will be seen in either reversals where we're starting from a genuine bottom, or indeed they will start off and then they'll follow through, and you will see these in strong uptrends. You can see strong uptrends, and the corrections are these ABC type corrections, and you can quite often see these Gartleys running all the way up a major trend. Right, so there we are. Let's have a little look at that one. Now, let's look at the variation on it, which is the bat pattern. Nothing to do with the bats that fly around in the middle of the night. But let's just have a look at it. It looks very, very much the same. The pattern, the style of the pattern is exactly the same. But what we're concerned with here is that B, this point B, after the big move up to A, this retracement is going to be not so deep as the Gartley. All right, so it comes down there to 38.2 ideally, but no more than 50% of that X to A move. Now, point C is going to bounce back up, and again, it's not prescribed here how far C is going to bounce back up, but it's going to bounce back up and it's going to turn the corner, and quite often what we're going to find now is that move C to D is going to be much more than a measured move, because it needs to go all the way down. As you can see, it's going to go all the way down to the 88.67. Okay, retracement. Excuse me a second, bit of a frog in my throat. So if one wanted to trade the potential measured move on this pattern from point C, provided that one can see a little bit of reasonable evidence there that that is a reversal, once again at a fib or with a candle, maybe something like a shooting star or an engulfing, etc., then the move from C to D can be a very, very tradable move. But then, of course, the trader has got to start to look at what this pattern could become. And if the trader can see there that right down here at 88.67, price is actually running out of steam on the downside, then the trader's going to close that position and get ready now to trade the Gartley. Now, again, what we're actually seeing here with this move is that this can be an absolutely explosive move, and consequently, traders just love it. If you can find bat patterns, and it may well be in an established trend or not, as the case may be, it may be just coming out of a reversal, you can be reasonably well assured that when this starts to move, it is going to move, and you're going to be on for a real roller coaster ride. Not necessarily too many downs, but plenty of ups as this then moves on up, and it follows up to this this C and A region. Yeah, good point, Ed. It's not quite so reliable as the Gartley. The Gartley is the good standard reliable one, and the back pattern is not quite so reliable. It's not quite so reliable. Now, as with all patterns, there are always exceptions. There are always going to be failures, things that just don't work out. And with both of these, both the Gartley and the bat, if the rally up from point D just sort of runs out of steam, and then it pushes on through, putting X then under pressure, these failed patterns can be equally explosive on the downside, can be equally explosive, can be really quite useful. Right, now let's just have a look at these. Yeah, the butterflies, the slight variation, and you can actually see these butterflies. Yeah, I spent a bit of time with Larry Pesavento some years ago, and the wolf wave, absolutely. These are all related, absolutely all related, and there are sort of variations on the theme. And Larry, we were just sort of playing around with our screens, and he absolutely loved the butterfly patterns, and he used them all the time. So let's just look at something from a real chart here. This is here we are talking FX, and I've got a non-FX example for you, but it's the ES, the S&P 500. So what's actually happened? Price has been moving on up. It then came to a top. The trend started to change. It started to roll over. Just look at that big engulfing candle there, and then it came on down, and it started a new trend here down at A. As it broke through those previous higher lows. So the new trend is sort of officially established when that actually happens, and we've got a series of lower highs, lower lows. But then, of course, we get the bounce back. And we've got this ABC type move. We've got A to B, well, B to C, C to D. This is the standard sort of move back up. Where does it move back up to? Well, that moves back up to, from X to A, 61.8 or just 62%, we call it. And then from D, it then decides to move on down. So, in fact, I've led you slightly astray there. B came up to 61.8% of the move, X to A, and then D is 78.6. Right, so on down it moved, and of course, there we are, the candle evidence, big, deep, engulfing candle, and of course then that set the scene that this was going to move on down. Then, what did price do? Well, it rallied here at 1450 in the region of the previous low, and the rally back up then ran out of steam, and on down it went. So, now, what you will probably have seen also here is that there is a whole series of little multi-point reversals. And let's just look at these. Yeah, let's just look at these entries. Number one is right up here at the very, very high on this chart. Okay. Now, there is a potential entry there, and it's purely on candle evidence. It's not on trend evidence. It's not on a full multi-point reversal. But if one could add maybe something else that is not on this chart, which just might be that is popping up to a previous resistance area, maybe a fib. But then just look at it. It is an engulfing candle. Okay. On this move up, it's the biggest and clearest bearish candle that there has been, followed by an Hallmey. Okay, so we've got a little inside bar there. And then, of course, price broke out from there. So there is an entry short there. Okay, but what I much prefer to do, I like to wait for the multi-point reversal. So let's call that point 1 right up there. It then came down for a fairly deep correction. I mean, a deep correction right down to this support area. So I'm going to call that point 2. And I'm going to call point X 3. Okay. Then as price caves in, there is yet another entry as price moves away from X on this one. Then it comes down, finds some support where it previously had found some support. Okay. Note the long tails. Just love those long tails. I am very much a tail man. I look for tails on these candles, and they tell more of the story to me than the body of the candle. Then what does it do? It attempts a rally up, just completely fails. Then we've got a breakout. So breakout traders can take the short here. But of course, breakouts are fraught with danger. So why not wait beyond breakout for the pullback? We've got another pullback here, and then it moves on down, Hallmey, etc. So we've got multiple entries all the way on down here. But just looking at this, let's be a purist looking at this pattern, this Gartley pattern. Then, having identified the pattern with the X to A to B, B to C, C to D, and then what do? We find we've got this big engulfing day, this engulfing candle. As it engulfs, that's where the short wants to be put in. Okay. Now, if you want to wait a bit, then yeah, there's always an opportunity to wait for the pullback. The pullback came through here. Now, I've not actually got the fib grid on. In fact, if you can just bear with me half a mo, I'm going to pull in a fib grid. I've got this little fib grid that I had programmed quite a few years ago, which is an overlay fib grid that can be put on now. I don't know if you can sort of see that all that clearly, but it's quite a reasonable little grid. It's rather like electronic dividers that back in the days when we were all using paper charts, then dividers is exactly what we would have been using. So look at that. That pops all the way up 2 of that preceding swing. 79.8. Well, okay, let's just more or less to the 78.6 there, as you can see. That's absolutely spot on there. I'm now going to bring that one down because let's just look at this level, which is this other entry, this pullback entry. Where does it pop up to? Again, spot on the 78.8. By the way, if you want this this grid, you can have it on a sort of a 10-day trial basis. It's not very expensive. If you go to www.fibgrid.com, okay, fibgrid.com, you can actually get the download there. Right, let's just pop that away. So there we are. That's yet another entry there. So on down we go. On down we go. Target area 1, okay, is just down here. And then price moves on down to the Fibonacci multiples of that A to D distance, and the whole thing comes to an end with these long tails. Get the long tails, then forms into a multi-point reversal, now a bullish multi-point reversal. And as you can see, this thing could develop if where the very, very last candle, if that now came down to the region where my little pointer is, somewhere below 1300, then that's probably around about 1275. That would then be a bullish Gartley, having moved down from this bearish one. Right, here we go. Well, again, I've got to apologize to you guys because I've got another example here which is non-Forex. Now, I very rarely trade the likes of Google. I trade Forex quite every single day, but pretty well every single day. But let's just look at the same thing again. We've got price that's moved on up here. It then corrects all the way back and looks very much as if it is breaking the preceding uptrend. We then get the move back up. We get the move A to B, B to C, C to D. Again, that's that Elliott wave move. And there we are. Up it went, and it moved all the way back up there. And D is 78.6. So again, that completes the Gartley. Ends with a shooting star, not a particularly convincing shooting star, and then it comes on down. So that's the entry just there. Short and a reversal from D. Stop, of course, above D. Tight stop. On down it comes. And just look at this, how this hammer then pushed price on up to attempt to get above D. Didn't quite manage it, so you've got a secondary entry here, which arguably is a better entry. It's a sort of potentially a safer entry. Where's the target area? Well, the target area is in the region of A there, and the second target area following through on the multiples of the A to D. And as you can see, we start to then get long tail candles. I will actually just bring this fibonacci back in because, bear with me half a mo. I just want to look at these targets really in relation to what we were actually looking at there. Let me do this now. No, it won't for the moment. My apologies for that. Let me just move that back away. And back to where we were. So the move looks as if that target area with that long tail, that's a good place to take it, at the very, very least partial profit. And then on down we come. Right, let's look at one or two other examples. We've got yet another one here where price is actually moving down in this trend moving down. And X2A looks like just an acceleration of the downtrend. And then we've got the move back up. A to B, B to C, C to D, reverses, and then it attempts this. Again, big move back, and then it moves on down. Right, here we are. We've got another one. We've got this down move, lots of long tails here, bit of a mess of a chart over here on the left, but then the move gets going. So we've got X to A. This is well and truly a bullish one. Then we've got the series of waves. We've got this sort of fairly clearly defined 3 to 5 wave move back to D. And then what happens? You've got the entry there, target area 1, target area 2. Right. Now then, here we are on to cable. And what do we got? We've got over here prices. You can look at the numbers on the right there. This was done quite some little while ago, this particular chart. Don't think we're going to see those numbers for a long while. And what has happened here? We've got the move on up in November. Came to an end with that big engulfing candle. Yes, there was a preceding engulfing, but price then moved on up to here, up to X. Came down for a deep retracement. Rallied back up with the ABCD move, and there we are, up it went, and of course at D that was the reversal. On down it came. Then we've got quite an interesting little engulfing here that didn't follow through. That arrow is not quite the perfect place. It slightly obscures the Hallmey there, and of course as the Hallmey broke, then it was on down. Target 1 reached, sliced straight through. The rally back, the inevitable rally back, there is usually, let me modify that, there is always some form of a corrective rally or indeed retracement. And so often, that is really confirming the move. And when it breaks out of there, then we've got a pretty good idea that it's going to move on down. Get a Hallmey, trade the Hallmey break. On down it goes. And then what happens right down here? We then get from that bearish version, we've now got a bullish version. But this time, the difference is that it's a bat. Now, X then marks the low with an engulfing candle, pops up to A. We've then got B that doesn't come down below the 50%, pops up to C with a bit of a half-hearted move, but then comes down to D, which is all the way down to 88.67. And it comes to an end there with an Hallmey. The next candle doesn't quite engulf, but it goes higher. That is the key to go long. And this is a bat pattern. And of course, targets as previously mentioned there. Target at A, and there'll be another target up here at around about that 2.02 mark. Right, now, down to a 15-minute chart, something a little bit more interesting. Intraday, what have we got? Let's just follow this thing through from the left-hand side. And so often, you're going to look at a formation of what is going on with price action, and it doesn't neatly conform to anything. You might think, I'm always looking for head and shoulder. I'm always looking for double tops, triple tops, or, I'm only going to trade flags and so on. But so often you look at a chart, you think, well, what actually is this thing that I'm looking at? Well, quite often they'll have little bits of characteristic of each. But here we are. We can identify the sort of X has been top, pops down to A. Then we've got this measured move on back up. Got a reversal candle as it sort of breaks out of the Hallmey. And then price doesn't neatly conform going straight to the A area, which is the first target. It moves sideways, and it does so, and as you can see, for quite some considerable period of time. So the trader's probably gone short there, stop above D, and is starting to think, is this going to follow through? In fact, that trader might even get fed up with it and decide that as it hasn't followed through, going to close it. There it is, getting up to, certainly for us Europeans, getting to the time when they're probably thinking about going to bed, and it then just goes sideways. But, had that stop been left up there at D, eventually, there we are, Following morning, 6 o'clock, breakfast trader, which is the thing that I absolutely specialize in. We've got a beautiful little setup there. Pops back up. You can see pops up to a 78.6 of the distance between D and the lows down here at 195.80, and it does so with this beautiful little sandwich. Okay, there we have not quite a doji sandwich, but we've got a narrow range candle which have been completely engulfed. It has been sandwiched, and of course there we are. Ideal time of day to trade. Down, down, down. Got the target area 1. Got the target area 2. Eventually, you can follow these down through to the target area, the final target area. So, how about that for a beautiful looking chart? So, there we go. That's more or less completed a little look at this lot. As I mentioned, you can get hold of that fib grid, which you can just overlay on anything. It's not attached to any charting package. It just fits on your screen, and anything that's underneath it you can plot. Now, Gartley, of course, came from HM Gartley, and then Scott Carney started to put Fibonacci with it. And of course, Larry Pesavento has done an awful lot of work on this, and I thoroughly recommend Larry's book, which I can see behind me here. And Larry's written a whole load of bits and pieces. Fibonacci ratios with pattern recognition. There we are. I'm going to promote Larry's book. And another one which is well worth getting a hold of, which is a book by Siri Dudella. Siri has done some brilliant work on patterns in general, trade chart patterns like the pros, and I recommend his book as well to maybe take you a little bit further. Right, there we are, guys. That's that just for now. That's that presentation completed just a little bit ahead of time. And let's just look at a chart of cable, which has been moving substantially lower this morning. But let's just roll this one further out. And right, well, there we are. Yeah, absolutely, Boyke. Yeah, absolutely without a doubt. Now, just taking this weekly trend, this was not a perfect example by any stretch, but this again brought in some of the features of what we'd be looking at on a bearish Gartley. Right, okay. So, yeah, Boyke, in answer to your question, yes, most definitely. This thing started off with a pattern, which is a multi-point reversal. It's got some characteristics of the Gartley, but what could be happening right now, what could possibly be happening, is that this whole thing is turning into something of a bat pattern. Now, I'm just going to put one or two little lines on here. Bear with me while I do that. And we can start to see the makings of this pattern. Now, what I've done so far, this little point down here, okay, this little point, is possibly, well, it's not deep enough for a Gartley. It would need to be somewhat lower down. But it's within the 38.2. Well, in fact, let's just confirm that. Put the fib grid on. And there it is. It pops down to 38.2. It's actually just slightly above that. And then it pops up. So this has got the starting characteristics of a bat. And let's put another line down now. We're going to take it from there. This is not really low enough for a bat. For a bat, it's got to come right the way down to this region. In fact, let's just put the grid on, and that'll show us exactly where it needs to come to. Yeah, well, it's more or less where I put it. Price for a bat pattern to be completed has got to come all the way down there to the big round number, which is, look, 10 cents away. 1,000 pips away, more than 1,000 pips. 1,150 pips away from where price is right now. And that could develop into a bat pattern. So there we go. An interesting one. Right. So let's go look now at, let's bring the time frames down and let's go to 30 minutes. And we're going to look at very briefly at one or two breakfast trades. Let's just pop this to a 5-minute. Well, Philip, who knows what is going to happen? Of course, today is the day when Gordon is going to announce when the election is, and goodness knows what is going to happen. I guess that there'll be plenty of mayhem going on at that time. Right, guys, let me just mention a breakfast trade. If you're interested in getting more information on the breakfast trade, go to www.clickevents.co.uk, but not until Thursday, because I've actually got a CD workshop which is going to be released at the end of the week. Now, in fact, it's going to be Friday this week. I do apologize. So let's just look at this. What very, very often happens is that around about 5, 6 o'clock in the morning through to 7 o'clock, there are going to be some really good moves. And as you can see, there was this morning, there was rather messy price action, not terribly clean. Yeah, you know, there were one or two trades to be had, but I like to get my trades all done and dusted before, oh, that's actually happened, is it? Right, 6th of May. I like to get my trades done and dusted really before 8 o'clock in the morning. It leaves the day clear to do other things. But of course, as we can see, price then just moved on down, and it moved down substantially. Now, one of the things to always keep in mind when you're looking at trades, no matter really what time of day it is, price actually, there we are, 1 o'clock in the morning, started up there at 153. Typically in a day, cable is going to move around about 170-ish pips, okay? So there we are, by 6 o'clock in the morning, it had already gone through 80 odd pips. So it had gone through around about, not quite, but around about 50% of an average day's move. Well, what has it done now? Well, it's gone from 153, it went down all the way to 151.20. So, you know, that thing has now completed its move for the day on the downside. So the odds of it, you know, expecting this now to go for another 100 pips on the downside are now very, 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 very much reduced. And, you know, we could more likely see this pop on up. Anyway, let's go back to yesterday. And the morning yesterday gave us a lovely little run. Okay, there we are, 6 o'clock. 6 o'clock in the morning, we've got a nice little rally up. Then price obliged. It obliged with nice little candles with some Fibonacci. Quite a few other bits and pieces we've been talking about this morning. And it moved on down for a move which was, in pip terms, worth 25 or 30 pips. The euro was worth actually more than that. So if you trade several of these first thing in the morning, who needs to trade for the rest of the day? Well, you know, things do then mean that you get your pips tucked away first thing in the day, and you can go off and do other things. Now, as the day progressed, of course, you know, there are all sorts of other opportunities there. And for those traders who want to trade all day, there were plenty of opportunities. Anyway, guys, time is now, my allotted time is completed. It's 11:45 here in the UK, 11:15 over there in Europe, and what local time? Right, it's not like a standard. It's around about 6 a.m. Now there is no central exchange, so it's not as if somebody has an opening bell and a closing bell, but it's fairly fluid around about that 6 a.m. to 7 a.m. period when Europe really does open, because, you know, you've obviously got European traders, German traders, Frankfurt and so on, guys getting to their desks, and then we've got all the guys down there in Canary Wharf in London, they're getting to the desk, all around about that sort of time. And of course, you know, there will be pent-up orders from overnight, which are sitting at their desks, waiting to be filled, and of course, that's quite often what will kick off those early morning trades. Anyway, guys, been good to be with you this morning, and I'll be with you again in exactly a month's time. I'm actually taking a week off, doing a spot of sailing in the middle of April, so I will be with you again on the first Tuesday in May, which is the 4th, Tuesday, the 4th of May. Look forward to being with you then.